Okay, good morning, everyone. Welcome to the staff's roundtable to discuss certain topics included in the Commission's proposed rulemaking on customer protection, enhancing protections afforded to customers and customer funds held by futures commission merchants and derivative clearing organizations. That was published for comment on November 14th, 2012. The rulemaking contemplated a 60-day comment period, which has been extended for another 30 days to February 15th this month. To date, you know how many letters we're up to now? We're over 40, right? Yeah. Up to 70 now? All right, so we're currently up to 70 letters, which we will be going through and, of course, responding to when we get to the final rulemaking. Today's roundtable will focus on 4 topics that arise out of the proposal. First, we'll look at the proposal regarding the periodic engagement of an exam expert to review SRO examination programs and the execution of those programs to assure that adequate procedures are in place and are being followed properly. Secondly, we will look at the proposed additional reporting and firm disclosures. Third, we will discuss acknowledgement letters for customer accounts and related requirements. And fourth, we'll look at certain proposed requirements for regarding customer margin. In terms of housekeeping items, the bathrooms and the telephones are out in the back. The first session today will go from now until 11 o'clock. We'll take a 15-minute break. And then we'll have a second session which will go until 12:45 when we'll break for lunch, and we'll start again at 2 o'clock for the third session. We'll go to 3:15, take another break, and then go into the fourth session. We'll end by 5 o'clock today. The typical disclaimer in this roundtable: staff may express views and thoughts on various topics. Any of us might do that, that person's views and thoughts are those of the individual, not those of the commission or any of the commissioners, any division, or staff generally, or any other staff. Okay, so let's get the first session started, focusing on the exam expert. We're extremely grateful to have this panel with us. Thank you so much. Let's go around the table quickly, stating name and company affiliation. And we'll start here, and then we'll come around and we'll include the staff at the end.
I'm Rich Flowers from Grant Thornton.
Thanks, Rich.
Mike Jamroz from Deloitte & Touche.
Dan McIsaac, KPMG.
Joe Palumbo, Ernst & Young.
Ann Bagan, CME.
Grace Vogel, Financial Industry Regulatory Authority.
Regina Thole, National Futures Association.
Sam Telzer, PricewaterhouseCoopers.
Michael Stevenson, Public Company Accounting Oversight Board.
Cam Nunnery, Office of the Chief Economist, CFTC.
Tom Smith, the Division of Swap Dealer and Intermediary Oversight.
Gary Barnett, Swap Dealer and Intermediary Oversight.
And Kevin Piccoli, Division of Swap Dealers and Intermediary Oversight.
Great. All right, so I'm going to start with, we have a lot of accountants here. I'm going to start with a non-accountant speak question, and then I'm going to turn it over to my colleagues and let them have at it with y'all.
Get the lawyers out of there.
No, get the lawyers out of there, right?
Yeah, some good conversation.
Right. So our proposal seeks to have an exam expert periodically review the joint audit program and the execution of the program in the examination of FCMs, and to take a view about the adequacy of both the program and its execution. Can we get that sort of review and assurances from an exam expert? Can we get what we're looking for?
Okay, well, let me, I guess, just sort of kick it off with, I want to just try to cover a bunch of different topics here. One, what type of reports can be issued, going through a number of different possibilities that are out there. Are there any difficulties in issuing such a report? What standards do we need to consider to measure against? Because any report, we need to have something to measure against in order for an exam expert to report upon. then talking about the scope of the report, timing and costs, and then what would be, qualifications of an exam expert. What should we be looking for in an examination expert? So let me just start off and with the initial, what type of report could be issued. So let me, I guess, throw it out to the panelists for specific thoughts on the types of reports that we could issue that would accomplish our objectives. So anyone like to start? Joe?
Yep. Thank you, Kevin. We thought a lot about this, and based on what I think the Commission is trying to accomplish here, thinking through the different types of reports that can be issued, a findings and recommendations report comes to mind, and that's under Consulting Standard 100. That's AICPA CS 100. Gives the opportunity for the examination expert, using a prescribed set of guidelines or certain standards that we're asked to look at, to provide for findings and maybe industry recommendations on ways to improve, enhance, or think about ways to incorporate best practices that we might see. So that consulting CS 100 findings and recommendations is something that's used widely in practice and could possibly fit the bill of what you're looking to do.
Kevin, I think maybe there's a framework we should start with, because Joe rightly points out the consulting standard. So the rules right now as proposed talk about an attestation. And an attestation has a meaning within literature, which is there's a set of standards issued by the American Institute of CPAs that refers to attestations. And within that, there are what I'll call four broad-based attestation concepts. There's AT 101, which is referred to broadly as attestation engagements. There's AT 201, which is agreed upon procedures. There's AT 601, which is a compliance attestation. And there's AT 801, which is reporting on controls at a service organization. AT 801 used to be known as SAS 70. It was reorganized in the last few years to be under the attestation. The thing with an attestation, except for AT 201, which is agreed upon procedures, is it is a report by a CPA over management's assertion. So management asserts that it has a certain set of controls. The CPA tests those controls and then opines on whether or not those controls are operating as either designed, which would be a type 1, or as designed and operating, which is a type 2 report. So again, you have stripes and flavors depending on what you want. I think one of the questions is, and I should say, by the way, AT 201, agreed upon procedures, results in no opinion. It is literally procedures agreed upon on which a report is issued. So one of the questions that I really pose is, what does the Commission want? Because if you want an opinion, you somewhat put yourself into the attestation bucket. If you want to report on findings, recommendations, as Joe properly points out, you put yourself in the AICPA consulting standards bucket. Either one is fine. We can do those type of reports. It's really a question of what do you want.
I think, Sam, the key should be that we actually go through the flow of how the auditing standards work to get to either a 601 or potentially a reverting back to 101, and then you get an exception to go to the statement of standards for consulting standards. So I have a chart here. I could probably pass that to Kevin to how exactly this works. Maybe on the chart, it indicates what the type of attestation standard, other attestation standards decision flow for financial statements, internal controls, service organizations, and AUP and other procedures. And then the first question is the subject matter material, is it related to the financial statements? The answer to that is no. So then you go over to the next bucket, which says, is the subject matter related to reporting on internal control? And the answer to that, you say, well, yes. And then you say, are the controls related to the service organization that provides services to other parties? And the answer to that, maybe yes. But the actually you're going to go up and eventually you're going to get to the is this an agreed upon procedures report? And the answer to that would be no, if we don't really have one. And then the next question is the subject matter compliance with regulations from a contracts or grants? So if it's it's a relative to a compliance with a contract or an actual report, that could be possibly your section be developed here for out for exposure. But if the answer to that is, so that would be on the regulation 1.52. But if you don't meet that, if you don't really say it's not 1.52, we're not going to do compliance with that. If it was going to be compliance with that, that would be an AT 601. If you don't get that, then you drop down to the question of the is the subject matter a discussion and analysis under SEC rules and regulations? No. Then you go through all these decisions and you revert back to AT 101. That's the only other place. Then you go to AT 101. It says under AT 101 that the reality is there are actually some exceptions associated with AT 101. And one of the exceptions is that you get a statement of consulting standards is part of the exception that you would have to issue a report on. So reverts back to exactly what Joe had said and what Sam had said. If you're going through the actual regulations for that chart that I just gave you, you'll get back to either a statement of consulting standards, which could be a report. It's not an opinion or anything like that. It's just a report, statement of what we actually did. The alternative is that if it really is in accordance with these regulations, this rule 1.52, then it could be a 601 type report. In either case, it would be not be an attestation report, but it would be a report describing what exactly you wanted. And I think that's really up to you, as Sam has said, that really the question is, what do you really need? And we want to be responsive to that, and we found the chart that goes through that gets us to that position. And I think that just to conclude a little bit on that, I think Regina has just gone through this with respect to the report by the Berkeley Research Group that the NFA engaged them to actually do a report. It appears to be a consultation report. It includes various areas that would relate to both the Joint Audit Committee's positions on how the NFA should actually perform their audit, but it also includes a number of references to auditing standards and to the PCAOB standards, but it is not specifically referred to as being in compliance with either the auditing standards or the PCAOB standards. But it does. It's a consultation report selecting appropriate components for that as a guideline. And I would say that the appropriate components you could either encompass in your Rule 1.52 or just leave it up to discussions with the whatever firm you engage to do that. And I think that would focus on risk to the extent that you wanted to. And I think that a consultant's report on that would be appropriate. And included in that risk report might be a little bit better description of what the work is when we evaluate risk. While they make reference to the auditing standards, I think that the example of the types of audit procedures or procedures that are performed when evaluating risk would be appropriate. And Sam could talk about this to great length, but it's the test of journal entries and things of that nature. that really apply to the audit of risk. Sorry for so long.
That's quite right. Thank you, Rich. Very helpful.
I actually have a more fundamental question, getting back to the basics of what is it, I guess to Sam's point, what are we trying to do here? Why do we need to have this done? As you know, we update our Joint Audit Committee programs every year, and the CFTC staff obviously participates in those meetings as well. And we try to encompass industry trends or developments. And we welcome suggestions from anybody on the committee or the CFTC for new steps that we should look at. This year, we actually didn't wait for the end of the year. We implemented a number of new steps mid-year. And so I guess I'm just confused what exactly we are trying to accomplish here. As you know, as far as implementation goes, your staff is in our department every quarter looking at our audits or our examinations and looking to make sure that we are following the standards, the Joint Audit Committee standards and the programs, and make sure that we are implementing and coming to reasonable conclusions on those examinations.
So basically your view is that the status quo is okay, that what we're doing is sufficient, and it will get the changes that we need in as it is? Is that what you're suggesting?
Well, I don't know that we need an exam expert to come in and tell us what it is that we need to implement in our programs. As I said, we welcome any suggestions on ways that we can enhance our programs.
Okay, thanks. I'm going to go back to a non-accountant question again. So in terms of the different methods you guys were, and the reference to the Berkeley report, I mean, so it was a review of practices and procedures and the execution of those procedures to assure that adequate procedures are in place and that they're being followed properly. But it was in that was how it was stated as the task. But then and then it had a bunch of recommendations. Now, with that goal and then the recommendations, I guess that's a consultation type report. And then how would it differ if it was an opinion? I want to understand the differences a little better.
Gary, to try and respond, the attestation reports that result in an opinion on a management assertion would be a recitation of what was done and whether or not the controls as described or the tests as described were operating. It would then result in a finding if the controls were not operating as described. So you would get the, if you will, the control, the description, and if it was not operating, you'd get a finding out of it. Except in the attestation case under AICPA standards, you're getting the opinion, and that's why I asked the question is, do you want an opinion? With a consultative report, which is what you see coming out of the Berkeley group, that is more, the consultative report does not have the opinion on it. So really the question is, it's a more free-form report, if I want to use that term, because it allows the author of the report to describe what was done and how it was done. The AT reports, AT 101 and the like, are more prescriptive in the format they follow. And if you actually look at some of the reports, which you can go ask some of your registrants, they get SSA 16 reports and AT 101 reports for a variety of reporting matters, you could see the difference between what they get when they engage someone to opine on either segregation or on custody or things like that versus what happens when you get a consultative report issued under the consultation standards. And really the question I ask again is, if you want an opinion says that management's assertion about their control environment is accurate and that there were no exceptions detected, or if there were, then you almost are forced into the AICPA attestation standards. If you say, I don't want an opinion, then you have more free-form flexibility using the consultation standards.
Gary, I'm sorry to interrupt.
Go ahead, Mike.
Going back to basics.
Oh, one thing. So Mike Jamroz.
Mike Jamroz at Deloitte.
Yeah, we have this for the transcript.
I don't know much about the Berkeley group. I don't think they're bound by our standards. And so while we would look at the report that they produced and looking down the list of things that we can do, it most closely resembles a consultant's report. you should understand, first of all, I think there are limitations on the distribution of our consulting reports. I think we can only give them to management. We can talk later about instances where we share them with the regulators of the company, but we would not make it public the way that Berkeley report was public. So I think that's important to know. To note. And the other thing you should note is that, well, I think that the comparisons drawn in that report to auditing standards are useful. You should also realize that the examiners of the NFA and the CME and other SROs are not doing a gap or gas examination / audit. So I think later, and I think some of the questions you ask about best practices, I think the standards that they refer to are more appropriately thought of in terms of either best practices or something to the extent that certain practices may, because I don't know that all of the auditing standards would be applicable to these exams, but some of them certainly offer information that would be helpful, you know, to use. So I think it's important to think in those terms.
And if I could just add on to what Mike said, because I think those are very good points. We haven't gotten to distribution, which is really what Mike brought up, is that when you look at reports that can be, I'll call, circulated, attestation reports, aside from agreed upon procedures, are generally available to customers and clients of or consumers of the information, so that the distribution restriction is lower, if you will, than it is with other type of reports. If you go into the consultation standards, and Mike properly points out, that is a report that really has a restricted distribution. It is only meant to be used by the management of the entity. And when you start adding the facet of availability to regulators, that engenders a whole different discussion about what do the regulators get, in what form does it get shared, what level of sharing occurs, is there privity to the work papers. There are a lot of different issues that come into that consultation.
Yeah, I think that's an excellent point, Sam, and I think if we can just table that for a second, and we'll get to that a little bit later, but just to try to just continue on this type of report. So going to a findings and recommendations, a consultative type report, if there are findings that come out of that report, it's basically just left, okay, here's what we did, here's what we found, here's our determination, and then it's up then to in this case, the DSROs, to respond and react to that. There's no requirement for the DSROs to say, okay, we understand your recommendation, here's what we're going to do to meet that recommendation. Is that correct? Or is that something we could put in?
Yeah, that's correct. That's correct, Kevin. But I also think, who would the experts be working for? The DSROs or the CFTC? And I think that has the bearing on how the reports come out and what we can do with them. If we're working directly for the DSROs, it's different than if we were working for the CFTC, reviewing it for the CFTC's purposes. You can then lay the groundwork of what you want us to look at, as opposed to working with the DSROs and how we're going to work with them.
And to your point, Kevin, I've seen finding recommendations reports where management is given an opportunity to respond to the findings and recommendations with its own thoughts, and if that's done appropriately, I've seen that done in under the standard.
And Kevin, if I could just add one other thing. You brought up the issue of the findings recommendations, which Joe and Dan both spoke about. When you have someone write a report, it is really up to the organization the report is issued on as to how they implement or change based on the remediation or recommendations. The people sitting around this table have no regulatory or statutory authority to require anybody to do anything. So just think about that as you go through these rules, which is that you need what I'll call an accountability at a certain point for the recommendations, because the recommendations are a negotiated item, but the implementation can't be negotiated. That has to be something that everyone agrees needs to happen, the time frame and responsibility, and the cost benefit for those.
Sure, I think that's a valid point, Sam, and I would suspect, though, that any recommendations that come out would be something that, at the end, either there's full agreement and it's, yes, okay, that makes sense, and here's what we're going to do to respond, or if there's not, then, okay, we don't, and here's why we don't, which can be an acceptable answer as well. But your point's well taken, Sam. Thank you. Yeah.
So if I were a third-party observer, I look at the report, I see the scope, we want the expert looks at the procedures in place, they look at how they were executed, and they've made some recommendations. And then accountability, the institution or the JAC or the DSROs, or whatever, they look at the recommendations, the CFTC is involved in the discussion. We have to come back to this question about who's working for who, but look at the recommendations, and let's say some of them deal with best practices, but they're lifted maybe from a prudential regulator context, or for some reason we don't take on those particular recommendations. We do 9 out of 10 of them. And then there's a blow-up. What should be inferred from the fact that a recommendation was not taken on? Anything? Or that's just considered in the context of the accountability, the consideration that was given to the recommendation and the decision whether to follow it or not? How would I look at it afterwards in looking at the fact that this institution engaged in this examination or this review and then decided maybe not to follow every single one of the recommendations?
Well, Gary, I would offer that when you read the report, as you say, as a consumer, depending on what style of report you're looking at, it probably will not have best practices. It will be very ritual-based, which is that this is what is being done, this is what needs to be done, and it would be very fact-based. So if there is a prudential regulator concept that needs to be brought in, that would be, depending on the type of report, that would be brought in based on the style of the report that would result in a recommendation.
No, excuse me. So then let me just change. I just picked an example. Pick another example, but one that would properly be among one of the recommendations. And the JAC everyone looks at it and decides, a lot of these make sense. This one, for whatever reason, cost benefit or likelihood of adding value, for some reason they decided after good consideration that they weren't going to take that one on. How should the decision be reviewed in the aftermath, let's say, of not taking on a recommendation?
I'll go back to what I said earlier, is that the people you have around this table as the panel generally don't have the authority to require anything. So if it's an agreement that there's an issue that results in a recommendation, then the organization that gets the recommendation would have to formulate an action plan. That action plan may say cost benefit means right now no, it may not be practical. There could be a host of reasons why something does or does not happen. But I would really leave it to the consumer of the report to determine how important that item is. And in this case, if the consumer is other than the DSRO, but also the CFTC, then you might have to make your own independent determination of that recommendation and then see whether or not you wanted something more robust than what the DSRO has agreed to do in that instance.
Okay, thank you.
Can I just add to that? I guess the question would be then at that point, is it the JAC sitting down with the CFTC, and is the CFTC is part of the JAC, and then what becomes public if we do decide, and I'm not assuming that there would be a recommendation that we wouldn't want to do, but assuming there was, is there some type of public record of what analysis we went through and why we chose not to put a recommendation into play? So, and I don't know what that process is.
Yeah, and just to be clear, I do not believe, and Tom, correct me if I'm wrong, that the CFTC is not an official part of the Joint Audit Committee. We're invited into certain sections and asked to it, but we're not an official member of the Joint Audit Committee. But putting that aside, Regina.
Just to clarify, though, that we do meet and discuss the program changes, so
absolutely.
Correct. I mean, I would assume that would be something that we would work together to make a decision.
Right. Yep. Yeah, and I think we'd all want to make sure that any decisions were thoughtful and with the proper analysis in a consensus reached as to the right way to employ or engage in any type of recommendation.
Could I also offer one other thought is, again, depending on what type of report you decide you might want, and this is going to key off a little bit of what Regina brought up, the availability of that report in a public domain could contain confidential information, could contain things that cause people who deal with that organization to not have the context of the recommendation. And depending on how that information is made available, that needs to be thought about and at what point it's made available.
So, Sam, I think you bring up an excellent point, and I know a couple of others brought that up as well. So why don't we just chat about that for a second? Because I know from the PCAOB, they have similar types of reports, looking at accounting firms, and they issue I guess, two reports, one that's a public report and one that's a private. So it may be possible another may be under our own regulations. It could, because it does have confidential information, it could be covered under as excluded from public domain because of confidential information in there. I think it's something we'd have to look at. But is there a possibility of going with a consultative report, splitting it in between a public section and a confidential section, if we could? Is that something that would be worth exploring?
I don't know, from a risk management standpoint, it raises a higher risk for the consulting firm on whether or not it's going to just the management of the firm or to a broader base, and that will have an impact on what you can do and what you will say. Most part, ours don't go there. They may go to a regulator, but again, it's all kept confidential. It's not something that the firms issue to their customers, to their any of their customers or counterparties. So I think releasing a report to the public would add considerable risk to the consultancy report, and what the standards are, and whether or not the understanding of what you would have to spell out in the report so that it's clear what the issues are. So
I agree with Dan. And back to what's been mentioned before, that consulting report is given to the firm or the company that hired us to produce and perform the report. And others, if they're going to use it, we can talk a little bit about this access letter. There's some agreement that any other user of those reports would have to sign and agree to. So just to echo what Dan said, public distribution of that is not within the AICPA standards of CS 100.
But I think you also have to keep in mind that it is the Joint Audit Committee and not just the DSROs. The programs themselves belong to the Joint Audit Committee. So there's not just a management of a firm. There's like 20 firms involved here.
That brings up a good point. Back to what we talked about before, who is engaging, I know the way the rules proposed, but who is engaging the firm to perform the report, to actually do the report? That has to be discussed, because that brings up, there might be multiple firms that are serving in the SRO capacity. That might have to be considered.
Right. I think the proposal is it's either the DSRO or the Joint Audit Committee. If the direction of the DSROs is to do it through a Joint Audit Committee, going through that.
Yeah, if you're going through the committee, then you're looking at the program in total, as opposed to looking at how it's taken care of by the various firms. So it's a different view if you're just going to go look at the program, say, yep, this program makes sense, or you're looking to see how the CME or the NFA or any of the other DSROs utilize that program and work through it. And that's the testing part that we usually go through, is looking at how they accomplish their controls, how they accomplish their goals.
Yeah, and the good news there is it's really just the CME and the NFA are really the two that do the execution phase. But the Joint Audit Committee does have, the firms do have equal say in, the testing and what should be done and how it should be done. But the execution phase is CME and NFA.
Kevin, one thing I would point out is that, and I don't want to say I'm an expert in this, but when you talk about the PCAOB style review, that required significant enabling regulation to have the Part 1 and Part 2 style reports done. And indeed, I'd even say when the DSROs carry out their exams of an FCM, those are not publicly available unless they result in an enforcement action. And even then, only thing in the public domain is the actual enforcement result, not the actual report that resulted in the enforcement. So I think that's just something that needs some thought process about what is it that you want in the public domain, and then whether or not, as Dan rightly said, from a risk management perspective, we'd be allowed to issue reports that bifurcate between what's in the public domain and what's not.
Yeah, no, thanks. I think it's an excellent point that we have to be sensitive to. And we'll have to look and see whether or not Article 8 that we have would keep this as confidential and not something that is disclosed to the public, which you would have to look at. I think normally when anything has proprietary or confidential firm information, that would be excluded, but we'd have to look. I don't know, Tom, if you had any thoughts.
Yeah, I think that's exactly right. We'd have to, depending on what was ever made public in this context, it would certainly have to comply with our statutory provision, Section 8, as to what could be made public. So that would all have to be looked at and to figure out what it is that the Commission, first, if it decided to make anything public, and then two, what can it make public?
Okay. Why don't we move on, if we can, to sort of the standards to be measured against? And I know there are a number of different standards that are out there. The generally accepted auditing standards, PCAOB has standards which, for the most part, encompass all of gas into that. There are AICPA standards. Institute of Internal Auditors has their own set of standards. And while I think there isn't one set that's just perfect for what we're looking for, I guess the question is it something where we can look and say, okay, within PCAOB, there's these 10 standards that we would like measured against, or, maybe it's a mix and match of, because the Institute of Internal Audit has some outstanding standards that they apply to internal audit groups that may have some applicability to what we're looking at here in terms of risk assessment and the like. Is that something, if we can just talk about the types of standards that are out there and how we can get that, because at the end of the day, we need to measure against something. And, existing standards are always a good way of doing the measurement. So if I can open that up for...
Yeah, Kevin, I think the way you described it's appropriate. There are a lot of standards out there, whether they be gas, PCAOB, or internal audit standards. There are pieces of which will probably be relevant for this. And I think looking through those standards and thinking about which ones do apply, whether it be in the planning phase, the field work phase, or the reporting phase, thinking about each of those and saying, is this something that applies to this specific situation? And that, I think, needs to be agreed to. The Commission needs to help us think through which ones would you like us to be looking at as well. The findings and recommendation report could contain an appendix that talks specifically about these are some of the guidelines that we used and some of the standards that we considered as we went through the report. The better that's defined, that will assist in the performing of something that's useful to you and meets your needs. So I do think that's a process worth going through and I agree with you. There are pieces of each of those different standards that you referenced that are relevant to this, but it would have to be carefully defined and gone through.
Yeah, I agree with Joe. I think the rule as it is proposed today is just too vague. We're not sure which standards we're supposed to be following. It's very generic, and without that specificity, we would have no idea which ones we're being held accountable for.
Yeah, I think both from what Joe and Ann said, I'd like to just add is, yes, the standards have pieces of applicability, But I would offer that if you step back and look at either PCAOB as it intersects with gas, those are primarily financial reporting standards and involve, if you will, the responsibility of a CPA in how they conduct and perform their audit to result in an opinion on a financial statement or set of financial statements. The IIA standards really deal with how an internal audit function does a risk assessment, how they conduct their examinations, whether or not their reports that they issue contain all of the appropriate steps and the findings and recommendations. And the AICPA, if you will, then layers in because they're the ones who issue gas for private companies. They also issue the attestation standards. They issue the consulting standards. So again, as Joe said, each of them has elements. The risk is if you're not clear on what the commission really wants, you get a hash total of adding up PCAOB and gas and AICPA, and you wouldn't really ever get anything that's opinion-like. You would just get a report, I think we talked about earlier, that may be more consultative in nature. But again, does that really serve the needs of what the commission is looking for, what the expectation is? So there's not a pro or a con. It's just there's no standard that exists right now, I think, that neatly fits some of what is at least proposed in 1.52.
And I think it's really important to keep in mind that what we do are not audits. We're not commenting on the firm as a whole or as a going concern. We are looking at specific regulatory type of requirements. So to hold us to gas or to PCAOB probably is not appropriate because that's not what we're doing.
And I think that's a great point. And but I think at the same time, there are standards that we need to make sure that are being employed, and whether that's standards on supervisory, how you supervise an examination, between the competency of the staff, work paper preparation, sampling techniques, risk assessment techniques, training of staff. I mean, those are all, I think, some great standards that are encompassed in the PCAOB, AICPA, and so on. And but I think it is trying to pick out and excluding certainly anything that's more financial statement related, because that is outside of our scope. But going through, but we need something to be able to say, that yes, we are measuring ourselves against the standard. Here's the bar that we're holding ourselves to.
Kevin, one thing that, as you think about 1.52, is if the commission wanted, and the DSROs agreed this was the right way to approach it, you could take the elements out of gas or PCAOB or IIA or whatever, you could embed those in the regulation, and then that becomes the measurement stick that could be used, because then you actually have a regulation that says this is the expectation. But that becomes very prescriptive, and the danger in being prescriptive is you leave something out that you really wanted, and you only get the result that it was designed based on the prescription. So with the proper thought, I could see how this could work, but it would require 1.52 being much more detailed than it is right now.
Yeah, and we get there a little, Sam, because we do talk about, here are certain standards, but I think that's a valid point. Thank you.
Yeah, I think that I was going to make the same recommendation Sam talked about, to make 1.52 a bit more descriptive with respect to what the work should be. To the extent that you're going to leave it up to a consulting review, then it's going to be more a discussion with you all to determine the actual scope of the work, and that would be described as part of the consulting process. But I think that the having a measurement stick of the standards embedded in 1.52 may be appropriate, in that it will capture what are you believe to be some of the certain exposure areas, and could be an evaluation of risk, could be a evaluation of the training facilities that are provided, and a lot of other specific items that you would expect to be encompassed in the actual report.
And I think the commission does start doing that in 1.52, and whether or not it's done in 1.52, that's probably an alternative. Maybe it could be done in the RFP process too, for the proposal process to, and that's just another alternative. And I'm sure there's pros and cons to that as well. But to give you a little room to change or to expand, as the commission would look like other topics covered. But just to echo what we've been saying, I do think important to lay out more specifically than what's currently provided, what specific standards are we comparing to, are we thinking about in the performance of this report?
And just to echo a lot of the comments, I mean, I think that it's, definitely 1.52 should spell out more and what the standards are. But I also think we have to be cognizant of the fact that the CPAs have a job to do and we have a job to do, and they're two different things. And where is there duplication and why should there be duplication and the cost involved and all of those things that come into play?
Yeah, I think that's a great point, Regina, because there are, elements, and the CPA has definitive responsibilities that we look for in the overall oversight program, and then the DSROs have other critical elements of the oversight program. So making sure that we blend those in properly, I think, is a very good observation.
I'll just make one comment. I think as part of the risk assessment, we as a regulator need to understand the segregation of duties at the firm as well as the competency of the accounting firm that's performing the review, and we take that into account in determining how much to rely upon the independent accountant's work or to determine, whether or not we need to do our own re-review of areas that the accountant may have conducted.
Yeah, I think that's a good point because looking at the accounting firm itself, not all are at the caliber at some of the folks in this room, and considering that in the risk assessment of the firm, and how much reliance can we place on for example, a one-person accounting firm. They're not going to have the same level of quality controls that a Big Four firm would have or a middle-tier firm would have that we would like to see, and that would definitely impact the risk that the DSRO has in their doing their exam and looking at to design their audit plan and scope.
So it sounds to me that there are two pieces to the review that you're looking for. One is a review of the procedures and components of the joint audit program, and then a second review of how each DSRO is carrying out that program. Am I correct in the way I'm thinking about it?
Yes.
But I think that the level of internal controls and in fact whether the internal controls are like working, and your assessment of those internal controls to the extent that they're fundamental controls, are they monitoring controls, and to what extent are they going to be given credit, to so to speak, to reduce the risk associated with the particular function that you're evaluating. I think that the quality of those internal controls should be part of the process, and that particularly with regards to the PCOB has been harping on us to make sure that we've got our internal controls have done the right thing and we've tested them correctly and made a proper assessment of them. And I think that is it's endemic on all auditors to follow those procedures. I think the specific with regards to the Berkeley Research Group, they indicated, well, there was a concentration of certain individuals controlled the firm. That would be a clear violation or raise awareness as to you have to change your audit procedures to take into account the risk associated with that concentration of personnel in a certain area. I think that particularly with regards to some of the controls, it may have been more fundamental controls, but if you were going to rely upon monitoring controls, which would have a broader basis, what would be the basis for permitting you to utilize monitoring controls? And that's something that the PCOB is actually held up quite admirably, I'll say, because we all like to love the PCOB. But that's been one of the areas that they've been adamant about.
Dan, I know you had to.
Yeah, I mean, I think also as you go through the firm, like Grace said, their assessment, when you go in and look at their assessment of what they've done, firms will have to recuse themselves from looking at certain firms. There's a confidentiality issue there that might be a problem for firms to look at. I certainly wouldn't be able to go into the CME and look at one of my firms that they did, because I'd be biased in some respects, but also there were things I would know that that they may not know, or vice versa. So that has to be very careful on how you do that. And I think it's also you really would have to understand what they're doing with the firms, and understand the firms more to really determine if their risk assessment was done properly.
And I just want to point out, too, that we do look at internal controls when we are planning our audits. We use that as an assessment of what type of scope we need to have. So we are looking at separation of duties or whatever. That's all part of the planning before we even walk in the door. We're asking these questions and finding out, have there been management changes or whatever, or who does what kind of controls are in place. So I don't want anybody to think that we're not doing that today, because that is a critical part of how we determine what needs to be reviewed on our examinations.
And I just want to add, though, having read the report that was issued last week by the Berkeley Group, there are some themes that are in there that the standards that a CPA follows would really talk about, and some of those things include the training of people to make sure they have an adequate level of knowledge about what they do, the review and supervision, the way issues are identified and bubbled up. So there's one part which is what's the control environment of the enterprise that's actually doing something. The second piece is that the people at the organization, whether it be the CPA firm or the DSRO, is how they carry out the responsibilities, because the PCAOB and GAS both have a lot of requirements about how an auditor is to discharge their responsibility. And what I haven't really heard from either the rules or any of the discussion yet is we talk about, if you will, the front part, which is how do you know if the entity that's being examined has a control structure, has management, has process. The second part is the people doing the examination need to have a level of competency and there needs to be a level of review and supervision to address this. And that right now is not captured in anything in 1.52. It is embodied within the requirements of GAS or PCAOB. So I'm wondering if you could maybe give us some guidance on what those expectations are.
Well, that's something that your staff comes in and looks at with us, what kind of training we have and what level of expertise and how long people have been in the department and, whether they have a CPA, whatever. So that is something that the CFTC does look at the DSROs.
And Ann, I'm just asking, though, if there's a report that the CFTC wants, how do those areas get encompassed? Because those are, again, very embedded within the professional standards that the PCAOB or GAS has. And everything we've talked about has more been about the entity that's being examined as opposed to the examining authority itself.
I don't know how off target I'm going here or how far off topic, but FINRA's annual regulatory and examination priorities letter recently came out, and in it, FINRA discussed it, the risk orientation and the control-focused examination was referred to in the letter, or short letter. So I just, that orientation, which we need to bring more into our orbit as well. How does what you're doing relate to the topics relate to this point that we're hearing about trying to provide more specificity on standards? I mean, what standards are you guys referring to or discussing or applying in terms of when you're telling people we want to see more risk orientation and control-based platform?
I think the annual examinations letter is meant to give a heads up to the FINRA member firms as to where we will be focusing our efforts in the coming year, so that firms can prepare for our examinations, and if there are areas of control weaknesses or problems, to the extent that they can correct those problems before we get there, that would be a good thing for everyone. From the standpoint of our risk-based examinations, we are receiving and will continue to receive a lot more data ahead of time, so that in an automated fashion, so that tests that we used to do manually by just flipping pages of a stock record and looking at every 30th item, we now have automated feeds coming in for the largest firms, and we're able to produce exception reports that identify samples for testing, so that when we go out into the field and we actually do our examinations, the tests will very often reveal the problems because the samples are a lot smarter. We also have extensive planning that's done prior to each examination. Our program is set up so that each firm has a coordinator or surveillance person who has the continuous contact with the firm throughout the year and ongoing monitoring of the various financial reports, and has ongoing conversations with the firm. They have an understanding of the firm's prior history, prior examination findings, and that coordinator is instrumental in working with the examiners in planning the scope of each examination. The examinations, there are so many areas to review at this point in time, we can't possibly look at everything. So when we say risk-based, it's really risk-informed to a large extent, so based upon the coordinator's knowledge and all the information that we have to review ahead of time, we are making a determination as to which areas to review when we're actually in the field.
All right, so I'm just, and then in terms of when you look at the adequacy of controls, is there a standard, or am I connecting, are the comments I'm getting from the participants go to the oversight of the examination process when you're saying you want more standards? Or would you be referring to the things that they, say, for instance, what standard does FINRA apply when they go to look at, test the adequacy of controls? Do you understand what I'm asking?
I think there may be two questions, right? So the examiners will review adequacy of controls at the firm. I think what you may be getting at is the supervision process at FINRA to make sure that the examiners are appropriately discharging their responsibilities. So for the examinations of carrying and clearing firms, there are two levels of supervisory review. There's an experienced examiner in the field, a manager in the field who's responsible for the review process. And then there's an examination director who is in the field and, in the office conducting that second level of supervisory review.
And we have that same thing at CME. And in addition, all of our examinations go through what we call a consistency review, where one person looks at every single exam that goes through and makes sure that everybody's treating similar items consistently. So every single one of ours, it's a quality review, if you will.
Okay. Just another topic, and I think we touched on this very briefly, but I'd like to spend just a little bit more time so we can get a little more insight into it, and that's new and best practices. And it's certainly something that we all need to make sure that we are constantly thinking of best practices, lessons learned, and building that into the program. How is that a concept that we could build into this expert exam report? And is it something that we can build into the report? Do we just leave it out there saying, and please comment on, whether or not the program met best practices, or, is considering current industry issues?
I'll offer just this view, is that there's no standard I'm aware of that I practice under that says comment on best practices as a CPA. So I think the first question I would ask is, who is best practice? What is best practice? Because, again, you need a definition of, my best practice may not be the same as what Michael's or Regina's best practices. So I think the thing is, you could ask for anything you want. Whether or not we could deliver it is a different issue in any form. Typically, because I'll give you this as a thought process, typically when a client engages us to look at a process, we do it under, and I think Joe talked about the consulting standard, you will typically say, here are known industry practices of the way things occur. And you can usually draw citations out of things that have been published in the public domain, and then use that as a reference point to give somebody some thought process about what they're doing versus what other industry participants are doing. If that's what you're aiming for, then try and define it that way, and then we have a measurement yardstick to use.
Let me phrase it differently then, Sam. I know when I was in private, in getting all the RFPs, all of the firms talked about how they know best practices and they have the experts and they can tell you exactly where, what you're doing and compare it to best practices. So how do we get, what normally comes out of an RFP where the firms are touting their expertise? How do we get that into something where we say, okay, now take that expertise that you all have and give us an assessment on how the program matches with your level of expertise?
You could, I think some of what we were discussing, I agree with all of it. You could, though, industry practice. There are industry practices, whether that ties back to a specific standard or whether that ties back to some published material, as Sam mentions. That's okay. We could do that. But there are accepted industry practices as well that I think, as you work through the report, if there was an area that we came up with a finding for, what supports that finding? What would be the reason for that? And if that is an industry standard, I think most would agree what an industry practice would be. But I agree with Sam. That concept of best practice is hard to define. It's something that many different people would have a different view on. But there are industry practices that I think most of us will agree in areas, whether it be accounts payable or whether it be another topic. There are industry practices that have been around for quite some time that we would agree, if they were not in place, would be a finding and could be compared to what we would say would be an industry practice.
I think we need to be a little more disciplined in our discussion about who we're talking about. So I think, strictly speaking, the way that this has been proposed, the practices that would be the best, that we would be looking for are the examination practices of the SROs, of which I'm told 2 do the exams. So the 2 of them presumably can talk amongst each other and determine what the best is. Now, I mean, I think it's important too, because we were kind of jumping to what is the best practice of the underlying entity being examined, which there are many, and I'm sure that people in this room can discuss for the rest of the day what best practices are to any related subject. But I think here we're really talking about examination practices. Now I think there is a role to play for firms like ourselves because we do kind of something that's similar but not the same. They're doing examinations. We do either a test, examinations, or we do consulting jobs, but either exercises some similar attributes. So we can say things and give folks who do something similar advice as to what we think works or doesn't work. But I don't think what you're looking for is like something there, some kind of thing where it precisely tells you what the best practices are, what the ideal standards are, exists. I think there are things out there that you can look to, and I think to some extent the auditing standards that you listed have elements of best practices in them. So if there's any one place to look, I think that's a good starting point among others. But I don't know that there's anything, any magic bullet here.
Yeah, I think that's fair, Mike. Thank you. And but I do think, I wouldn't limit to DSROs in terms of best practices, because a lot of what we're talking about, like planning and examination, risk assessment, I think it goes beyond just DSROs in that point. But you raise a very valid observation. Okay, why don't we move on
I think
to...
the extent of, for an example of data analytics, to the extent that the actual audit practices themselves do a lot of data analytics and utilization of that information, and how does that adjust? How is your actual examination procedures change because you analyze the data in a certain methodology? Could be some improvements on that relative to the amount of data that we now have to examine, particularly say for we wanted to identify some of the issues related to high frequency trading or anything that has a significant amount of data associated with it that should be evaluated. And the way in which we go about determining information out of that data, I think, is important.
Okay, thanks, Rich.
I'd like to just make one comment. I think we need to be cautious about coming up with a program that's very prescriptive and check the box like, because we need our examiners to think. They need to, assess the risk and keep turning over every stone. And if they're focused on answering lots of very prescriptive questions, then they may miss the
You're
next
absolutely
problem.
right. We don't want a tick and tie mentality. That's just, they're going to miss the boat. Okay, why don't we move on to qualifications? What would be the qualifications that we should look for in an exam expert? Can we throw that open to the group? What would you expect to see or recommend for qualifications?
I guess there's two phases of qualifications. One, the firm itself, and does it do similar type exams and know how to risk manage? And the other part would be also, do they understand the industry, I guess. So there's two parts of what an expert can do. An expert can come in and say whether or not you're doing the right training and things like that. You don't have to really understand the industry to understand that. But then you have to get deeper down to whether or not the firms that would be considered experts have the expertise in the business to determine whether or not the DSROs are looking at the proper, looking at the things that we would look at or what we would think would be a risk. So there's two levels of risk there. So I think you want the further down, you want somebody who does the work, understands the risk, but also understands the business.
I think you should strongly consider some of the reports by the PCAOB relative to the examination of the audit firms, and to the extent that they have cited that certain audit firms have done their assessment process more accurately or have fewer potential issues. I think this is an important area. I think that they're the ones that, forget the industry. They're looking at the real audit procedures themselves. To the extent that you've actually implemented those audit procedures adequately, I think that's an important aspect of this.
The thing I would offer on examinations expert is, when you talk about qualifications, I guess the first question I have is, what do you expect? What do you want from that expertise? In other words, do you want the firm and the person to be a CPA, or is that not relevant for this purpose? Because there are a lot of people who understand an FCM in the futures business that are not accountants and are not CPAs. Some are lawyers, some are operations people. So there's a wide swath of who's an expert, what does an expert mean? Within the CPA framework, as we talked about earlier, there are standards under which a CPA has to operate, which encompass quality and training, and if you're subject to PCAOB review, what the PCAOB says about your firm. And then you start getting into some of what I think Dan and Rich and Joe talked about, is the expertise of the industry, because obviously there are nuances within the industry, understanding how a DSRO operates, understanding the regulations, understanding how an FCM operates. So I think when you define examinations expert, part of what you need to start with is that what type of organization do you want to be doing that examination? Because if you say CPA, that has a particular meaning. If you say legal, that has a particular meaning. And if you don't define it, in the absence of that definition, it actually has a meaning. So I just say that, I'm not saying be prescriptive, I'm just saying the exam expert needs to have an appropriate definition to it so that someone could meet it and not be so prescriptive that it's impossible to find someone to do the work.
And if I could just come back to something I think Rich was saying, and I should say, first of all, as with you, my comments here don't represent necessarily the views of the PCAOB or board members or staff there, but I would just suggest that you be cautious about the extent to which you go down the road of interpreting publicly available PCAOB information about firms as sort of providing much of an indication on this question, that there, because of the way the law limits what we can make public, there are some limitations, I think, that would be important for this purpose, just how far you go in relying on or interpreting that to identify someone as qualified or not for the kind of work you're talking about.
Okay.
Are we just mostly done with the your question, Kevin, on examinations reports at this point? 'Cause I just have like a little different angle to go down, if that's okay with you. This is also part of the proposal, and I just wanted to get some feedback from this group here, and particularly, I think, Grace, you might have gone through this already. As part of the proposed rulemaking with respect to the certified annual report, the Commission is proposing that the public accountants be PCAOB registered and also subject to at least one examination, and have taken steps to address any sort of deficiencies or recommendations made as part of that review. I think from the analysis we have done, this is not a significant issue, just looking at the total number of our FCM registrants that we believe already do have PCAOB registered firms, but there will be some that aren't. And I assume, Grace, when this came through, this was an issue at FINRA and within the SEC when this became applicable. But looking at that, ours is not a requirement. Ours is the Commission is taking the action. In your case, it was a different, it was a statute. But one, how did the transition go? Do you have any thoughts for the Commission on that? And also the technical aspects of our rule, which require examination and require the response of the firm to those reports. If anyone had any thoughts on that.
After a lot of moaning and whining from the membership about the increased cost of having an audit performed, everyone did comply. I think what we see as more important is familiarity with the industry. So an accounting firm that has a number of broker-dealer clients generally has more expertise. So we flag when we do our examination planning a broker-dealer that uses an auditing firm for which they're the only broker-dealer client. That's a red flag for us. Or if there's a small number of broker-dealer clients, that's a red flag.
And in the proposal, the commission is putting an obligation on the FCM management in selecting the public accountant to look at such issues as, how familiar is that CPA, even if it is PCAOB registered, with the FCM world and the commission's accounting requirements. Do they have other FCM clients? So I think that's part of it. But some of the comments we received to date are talking about we're potentially excluding some area of the accounting professionals that would be competent to engage in these reviews. But I mean, our objective is we're looking for something more than the traditional peer review process. We want the PCAOB sort of oversight of these entities.
And as you said, I think one of the differences between what you proposed and what happened with the auditors of broker-dealers is that the auditors of broker-dealers were only required to be registered with the PCAOB, and you've proposed that they also have been inspected by the PCAOB. We do a lot of inspections and of auditors that have issuer audit clients, and the results, big pieces of the results of those inspections are not public, as we've talked about. I think you want to be thoughtful about how readily the fact that someone has an engagement to audit an issuer translates into, just because we've inspected them, translates into some heightened qualification to do work on FCMs.
Right. I'd assume, like, as part of your assessment of what to look at these organizations, you have your statutory responsibilities, that's broker-dealers and auditors of issuers, and not necessarily if they also engage in other types of firms, such as an FCM. That's not I'll call it a high priority. It's not your mandate.
That's right.
I think the big issue, relatively big issue related to the PCAOB is the extent of independence requirements for the auditing firm. And for example, our inability to do certain areas of work because it's prohibited. Certainly there are certain structural requirements because of the requirement for a used to be called second partner, but the engagement quality reviewer that performs that task. Certainly the depth of the firm is put under question if they don't have adequate resources to be able to meet the rotation requirements, which are required under the PCAOB rules. It's certainly more restrictive than the SEC requirements. So there are some added structural problems that have been placed before us because of PCAOB registration. I think that that's the compliance to doing the work. I think the actual evaluation of the quality of the work and the procedures that the accounting firms actually perform are certainly more onerous now with the PCAOB actual review. And I think that has stepped up our ability to evaluate internal controls and the way in which we go about documenting our assessment of the internal controls, and the fact that it's not documented, it's considered not done. So our level of documentation is significantly been increased on a required basis because of the PCAOB. So I translate that into your assessment as to using the PCAOB standards.
Right. And Rich, is that the improvements and your responsiveness to PCAOB, is that because of the review or just because of the potential, or you hear, hey, they're looking at this, so we better make sure we got this button down? Because I'm sensitive to the fact that Michael raised that not every firm is reviewed. So is it just the possibility that causes a firm to make sure that they do have the right quality assurance in place?
We obviously just wanted to comply with the standard gas before.
Tom, maybe I can offer something just as a thought process when you look at the competency of the firm doing an FCM exam. There are at least 2, maybe 3 flavors of FCM. There's an IB, there's an FCM, and then there's a retail forex dealer. And I think each one has its own quirks, if you will. And when you define, if you're going to, what a CPA firm needs to know about an entity, we could have 100 IBs. That doesn't mean we know how a full clearing FCM works. And you could do 20 retail foreign currency dealers. That doesn't mean you know how an IB works. And I think when you draw the net wide, it's fine, but you may get a result that you don't like if you draw the net too wide in terms of how you define expertise.
Thank you.
Are there, I think we've exhausted our questions. Are there things we failed to elicit that panelists want to offer up before we close the session?
I think that we should be cognizant of the fact that particularly dual-registered firms, to the extent that in the examination be performed by under the Joint Audit Committee, have in fact the issues related to the side of the firm that actually is under supervision by FINRA, have the risks associated with that firm in the execution of the examination under the JAC determined rules. Did they incorporate the activities of the broker dealer? Because I think that certainly to the extent that the JAC determined procedures oftentimes start with, well, here are the futures accounts, and let's balance the futures accounts, but we'll take care of the securities accounts differently. But I think that the reality is, in terms of risk, is you need to see both of them together to actually assess the firm, to see whether there's any potential fraudulent activity or other transactions that are happening across those entities. And I don't think you should be isolating work just on the FCM solely. And I believe that it's a lot more than just the MF Global issue.
Right. Thanks, Rich.
Yeah, I think that brings in, it's an issue for you, because I'm sure the CME and the NFA do consult with FINRA from time to time, and how far can the expert review those consultations, because now you're encroaching with something that FINRA may be involved in, or maybe, so, I don't know if the rules still affect them or how they encompass them, but that has to go into part of the whole concept of what they're doing from a risk management standpoint.
Yeah, I mean, to be honest with you, in thinking through the proposal, it seemed to me, my initial reaction, which I still have, is that to require any kind of exercise like this every 2 years across the board seemed to be, in my view, excessive. Now, that's not to say we can't add value. In fact, in the securities industry, where our firms, are asked by the people like FINRA or the SEC to do consultant-type reviews. They usually emanate out of an incident or an exam or both, where we design the consultant review around what the client and its regulator wants. And in fact, I think others, our firm included, have done similar reviews of SRO's exam programs at the behest of their regulator. So my reaction is that it's the kind of thing that, certainly given the few number of organizations involved, could be worked out as needed on a case-by-case basis rather than required, every other year on a comprehensive basis.
So doing maybe one up front?
No, doing it when you think it's needed.
Right, and then from there going on a
or whatever.
very specific
you'd
basis.
work it out. It just seems to be, because going back to Sam's point.
So, Mike,
about-
let me just, I'm sorry, I should just listen, but the futures space fell away, did not move towards risk and control orientation the way the security side did 4 or 5 years ago. So to just design some review for design around what the JAC and the regulator want may not get you to update and to take into account practices and improvements that may be needed. I mean, I think that part of the periodic review is intended to accomplish that. The idea that when we talked about best practices and we referred to industry practices, I was struggling with the idea that industry practice, if that just meant a space that maybe was too insular and hadn't taken into account what was going on elsewhere, was not going to get you to the right place. So maybe that goes to looking outside the space to other things and other ideas to be able to keep up and to change oneself when one needs to, just as the futures industry is trying to do right now. So I don't know. I guess that's my reaction to what you're saying. I mean, it just seems to me that you end up grading yourself on where you are. Well, how would you react to that?
Going back to Sam's point about the different qualifications of advisors in the futures industry, and also going back to what I believe, seeing some of the comment letters, is commentary involving the lack of specific standards to which we would do this exercise against. It would seem to me that doing or asking for these exams on a more specific case-by-case basis gets you closer to where you want, because we can agree to in our engagement letter to do specific things in specific areas. For example, the purpose of this roundtable involves custody. Your rule, as I understand it, that is proposed would cover, we would be looking not only over the SRO's supervisory program over custody, but things like sales practices and other things that that are really kind of a different set of skills and backgrounds. Different people in our firm would think about and do sales practice type engagements than those that do custody. So you're talking about a different background and expertise and a different set of kind of procedures or things that we would do or think about. So it just seems to me that it's a kind of thing that, you know, where we can bring value, but it's probably better done on a more selective case-by-case basis and then comprehensively across the board every 2 years.
Okay, thanks. Other thoughts before we close?
One proposal that the CME and us have talked about is, you know, we meet several times a year, the Joint Audit Committee with the CFTC, and we would like to look towards, you know, involving the CPA community or the auditing community to join in on those meetings. Maybe not for the whole the whole meeting, but to talk about standards and issues in the industry that we could then bounce off of each other as part of a process towards this. So I think we would welcome that. If there's other ways for us to join in, we're on a lot of different AICPA committees. If there's other committees, we would love to embrace that and join where we can add value. And likewise, we would welcome the value that we think bringing the CPAs to our meetings could bring.
I wanted to make 2 comments on risk-based exams. The first is that the CFTC will have to get comfortable that certain things will not be looked at. You know, we started the process probably 8 years ago with the SEC, going through the dialogue of, you know, these are the kinds of things we have historically looked at. In the future, we're not going to look at, for example, NSCC reconciliations or settlements, because if there's a problem, we're going to hear about it from the street. But we went through the litany of things that we're not going to look at unless we saw a problem. It also takes time to turn the ship when you have a large number of examiners, because you're taking them out of their comfort zone now that they're thinking risk-based and they're not following a very detailed program. So that doesn't happen overnight.
Yeah, very valid. Thanks, Grace.
Thank you, yeah. Okay, then thank you very much. We'll conclude this session, and we will start again at 11:15, I think, right? Very good. Thank you. Okay, we're going to get started. Welcome back to the roundtable on certain of the topics that were included in our customer protection proposed rulemaking. So we're going to move now into the second topic, looking at the proposed additional reporting and firm disclosure. And we're going to, this session will end at the latest at 12:45 when we break for lunch. And just a reminder again, the disclaimer that, in the discussions, individuals, staff may express views and thoughts on various topics. That person's view and thoughts are those of that individual, not those of the commission, any of the commissioners, any division, or any other staff. So let's get our second session started. And we thank the panelists very much for being here. Now let's quickly go around the table, each person stating name and affiliation, and we'll start with Alessandro.
Thank you, Gary. Alessandro Cocco from J.P. Morgan.
Ronald Filler, New York Law School.
Michael Greenberger, University of Maryland Law School.
Mark Holloway, Goldman Sachs.
Rich Horgan, Rosenthal Collins Group.
Doug Wolf, National Park Producers Council.
Bill Terrell, Bank of America Merrill Lynch.
Bill Thum, Vanguard.
Grace Vogel, Financial Industry Regulatory Authority.
Tom Sexton, National Futures Association.
James Catoulis, Commodity Customer Coalition.
Todd Kemp, National Grain and Feed Association.
I'm Cam Nunnery, Office of the Chief Economist at the CFTC.
Tom Smith, the Division of Swap Dealer and Intermediary Oversight.
Gary Barnett, Division of Swap Dealer and Intermediary Oversight.
And Kevin Piccoli, Division of Swap Dealer and Intermediary Oversight.
Okay. We should say DSIO from now on. It's too long, Okay. So to start off the discussion, we're going to look at proposed additional reporting and disclosure. We thought the best way to do that is Kevin's going to walk us through our existing reporting regime and then give a quick overview of the additional reporting requirements. So I'll turn it over to Kevin to start that discussion.
Okay, thanks, Gary. So I'll go through, here's what our current requirements are. Just sort of starting off with reporting requirements, financial reporting. On a monthly basis, we have the 1FR, the focus report. Quarterly, for any public firms, we'll get the 10Qs and the risk assessment forms that for anyone that has to file under 17H. On an annual basis, we'll get the Form 10K or F1 from a public company, the risk assessment from those have to file under 17H, the certified audited financial statements and the supplemental schedules, as well as the letter of internal control or material inadequacy letter from the accounting firms. So that's the reporting. In terms of notices that we receive, on the capital, I'd break this down starting with capital first. So the notices that we receive for capital on a pre-event notice level. There's really just two that we received. If an FCM has a reduction in excess of 30% or more, they need to pre-notify us. So if they're going to do a dividend, we have to get a notification. Or changes to sub-debt. On a post-event, again, just for capital, it's going to be under capital. They're under the early warning requirements. Margin call exceeds net capital or excess net capital. A reduction in net capital of 20% or greater. And I think there are a couple of others that get into different derivations of that in terms of percentage of decrease of capital or excess net capital. On the notices, again, for reporting, so things that are reporting in nature that they have to tell us on a pre-event notice, if the FCM is going to transfer or liquidate customer accounts at the initiation of the FCM, they'll have to notify us ahead of time. Change in fiscal year, an extension to file audited or unaudited statements would be a pre-event notification. And post-event notification would be failure to maintain books and records, a material inadequacy in internal controls, replacement of your CPA, failure to pre-approve a transfer, an SRO notice of a failure or a deficiency would come to us after the fact. A notice that the SRO has indicated that the firm is no longer a member in good standing would come to us after the fact. So those are the reporting. Just on the customer funds side, customer funds being obviously SEG and secured. On a pre-event notification, we have none. So there's nothing pre. On a post-event, if the firm is under SEG or under secured, they have to notify us, or under their RFED obligations, they would have to notify us after the event happened. And then just touching on public disclosures that are out there, we have the CFTC website, which has segregation data, secured, capital, and RFED obligations are there and posted every month, but usually around the 20th of the following month is when they get posted up there. Public disclosures, obviously the customer account agreement that customer signed would be a public disclosure. And then there is a risk disclosure statement pursuant to 1.55. I think all of these are really focusing on what we're getting on a pre-event notice is, as you can tell, a little bit limiting. And we get a lot after the fact. So after the event happened, they'll tell us, we're under SEG or under cap. So some of our proposed reporting requirements that we're asking for on a daily basis for daily SEG, daily secured, sequestered, as well as on a biweekly basis, a segregated investment report. Now, both of these, I should say, the NFA and CME have already put into their rules. We're just going to officially adopt them under the Commission regulations. So there's nothing there, but at least we will be getting daily information from these firms. On a notice standpoint, here I think on the pre-event, what we have proposed is more information about anticipatory events, whether they're acknowledgement letters from the bank. We've opened up a new bank account, SEG or secured bank account. Make sure we get the acknowledgement letters. If there is a potential of a material downgrade in credit worthiness or the ability of a firm to fund its obligations, that would be something. If the firm felt that there was potentially a problem for that, there would be a pre-notification. Or if there is the firm is going to get into a new line of business, or establishing or terminating a line of business, to pre-notify us of that event, or if they're thinking of changing their clearing arrangements, or anything that could impact liquidity is one thing that we want a notice of ahead of time, so that we can understand what's going on at the firm and make sure that the appropriate actions are taken. Some other proposed notices on a post-event. If the firm discovers that or is informed that it's invested funds inappropriately, that would be something that they would have to tell us that, yeah, we had a problem, we didn't invest in accordance with 1.25. If the firm does not hold sufficient funds to meet its targeted residual, so all the firms have gone through an exercise under Section 16 of the NFA rules to identify what their targeted residual level is. So to the extent a firm falls below that targeted residual, there would be a notification requirement to us. So it's not that they are under SEG or undersecured, but they've fallen below the targeted level that they think this is where we should be at. There'd be a notification so that we can then come and talk to the firm and understand, okay, what happened, why did it happen, and what are the circumstances. If the firm has a material change in its operations, all right, getting at our understanding of the operations of the business, the risk profile of the firm, so that we can make sure we're assessing the firm properly from an examination perspective, that we're looking at the right things. So if there's a material change in the business line, entering into a new business, that's something after the fact that we're going to want to look at to say, okay, how does this affect how we look at the firm, how we risk assess the firm, and design the oversight functions around that. And then the final proposed reg is if there is a notification by another SRO, the SEC, the FINRA, any of those notifications would also have to come to the Commission, so that we would be aware of an action taken by another regulator. On the proposed public disclosures, I think we're really getting at making sure that the public is notified of similar things. You know, what are the significant lines of business that the FCM is in, so that the public can get a level of understanding of what is the risk of the FCM that they're entrusting their funds with. Disclosing selected financial data, make sure that this information is out there so that the public has the opportunity to understand the financial information and can evaluate and do their diligence on the FCM. And then finally, just a description of the material administrative, civil, or criminal litigation against the firm. So again, giving the customers the opportunity to evaluate that in their decision-making process. So, I think that's sort of a very quick and high-level overview of both what we're getting now as well as the direction we're going in the proposal for the future, trying to just balance off pre-notification, pre-event notifications so that we can make sure we understand where the firm is, where they're going, as well as after the fact, making sure we understand when something does happen so that we can properly evaluate that.
And also allowing customers to evaluate an FCM prospectively. Do they want to choose a particular FCM, or on an ongoing basis? What's the status of their FCM, and what's the risk orientation? What are the risks they're facing with that FCM at that time? Now, we had a very broad discussion of reporting and disclosure. We've had now, this is the third roundtable we've had on customer protection, and the last one we talked about reporting and disclosure, and at the end of it there was supposed to be the buy side and the industry were going to have a discussion, and we haven't heard the results of that yet, so we'll be reading the comment letters with interest. And so our question to you is really, you know, within the scope of our proposal, both with respect to reporting and disclosure, you know, do we need to refine the language that we put in there to better pinpoint disclosures and reporting needed by the respective recipient? It may be the Commission on a lot of the reporting. Some of the reporting and a lot of the disclosures are for the customer. And so it's kind of a, you know, how did it come out, and what comments do you have on what we've proposed? And that is really a very broad question, but it does follow on a number of you, many of you were at the last roundtable, and we'd like to get your feedback.
Gary, could I kick it off? So
Yes.
I represent Vanguard. We're the buy side, real money managers, $2 trillion under management, 9 million shareholders. We have a conservative approach to using swaps and futures and FX to hedge portfolio risk, lower transaction costs, and achieve more favorable execution. Currently, we trade over the counter, and our swaps are fully collateralized on a bilateral basis. Collaterals held by a tri-party custodian arrangement, and there's no or limited fellow customer risk, fraud or malfeasance risk, investment risk, or operational risk. We applaud the CFTC's efforts over the past year to tighten protections afforded to customer, particularly addressing investment risk, margin shortfalls, fellow customer risk, and financial requirements. But at the end of the day, from our perspective, the main thing that we consider is the ability, the best protection we have is the ability to port our trades to a new FCM if we consider our existing FCM to be at risk. So the rules that we're talking about today largely go at the issues and provide the information that we're looking for to make a full and complete assessment. Vanguard seeks to protect the shareholder assets that are transferred to the FCM. Given the margin will not be held by a custodian, it's imperative that Vanguard has access to meaningful, timely information about its FCMs. And while we support the FCM reporting to the CFTC and to the SROs, such information must be made public. The information can't be withheld altogether or released long after it's valuable in terms of allowing customers to assess their FCMs. So among the current and proposed reporting requirements, the following are areas that we would be most interested that clients have access to. First is segregation computations, the daily reports that FCMs must hold funds needed to cover the equity of each customer. We'd like to see that released publicly on a daily basis. The monthly report on residual interests, showing the FCM's targeted residual interest in the customer account. Now, note that we think this should be amended to show the daily levels of the residual interest or the average level in a month, not simply the residual interest at month end. And we also think the FCMs should put this information on their website for the preceding 12-month period. In terms of financial statements, you mentioned the monthly unaudited and yearly audited statements. We're glad to see the yearly financials will be public. We'd also prefer to see the monthly unaudited financials, given that they're much more timely presentation of the FCM's health. We're glad to see the monthly reports include capital levels. We'd also like to see the monthly report include the balance sheet leverage ratio, which is referenced in the release. In terms of reportable events, currently the reportable events include failure to maintain capital levels, failure to maintain books and records, failure to comply with segregation. In the proposed requirements, we also think that they need to be made public, and these relate to investments not being in compliance with Rule 1.25, a failure to hold targeted residual interest, FCM parents or their affiliates having a material adverse change, or an FCM having a material change in its operations or risk profile. We need to see these made public to create a level playing field for customers to assess the viability of their FCMs. Certainly, Vanguard has wonderful relationships with its existing FCMs and has a close understanding of their health. That's why we chose them, and we have a rigorous due diligence process to assess them regularly. Not all clients have that same window into their FCMs, and to better protect the market and to also encourage the FCMs to comply with the rules, we feel it's imperative that these reports be made public. So again, at the end of the day, if the reports are made public, it provides the ultimate backstop for all the protections that have been written into the rules by allowing information to flow to the customers so they can port their trades to a new FCM ahead of a default.
Gary?
Yes.
May I just say a few
Go
words?
ahead, Alessandro.
Alessandro Cocco from JP Morgan. We're on FCM. And wanted to mention that we support the vast majority of the changes that are being proposed here and the disclosure to regulators, to our clients, and to the public. I'll get to the point where I say that there are some areas where we think that some thought has to be given about what is disclosed to the public. But let me tell you what we support first, so I'll tell you about all the great things that we think are wonderful.
Oh, good.
So, Regulation 155.0, for instance, the daily seg disclosure, adjusted net capital, excess net capital, we think all of that is absolutely fine. We support that fully. We completely understand the reasoning behind it. Some of the early warning signs that in the current proposed regulation are to be disclosed to the regulators, we actually support that because given that they are early warning signs, we think that regulators need to have some time to be able to perform their function, which is to either stabilize the patient or provide for an orderly transfer of customer positions. So that is for purposes of protecting customers in an orderly manner. And I'm referring to 112 HIJKLM. We support also several of the additional proposed rules that I think have to be seen in the whole context of the proposed changes. So, for instance, 111, the risk management program requirements, we think those are very thorough and completely understand the reasoning for them. The stricter audit requirements under 116 also make a lot of sense, of course, and the stricter FCM examination programs by SROs under 152 also completely support them. So here's where I get to the part where we have some comments. So, and I'm thinking mostly about 155K, which has a number of subsections. For that, we recommend harmonization between the various regulators, so NFA disclosure to NFA, to the CFTC, to FINRA, the SEC, and so forth, just so that we can compile these statements in a way that allows us to use them across the board. Hopefully, the information that we're required to disclose is essentially the same information, so we can do that in an efficient manner. And then getting to the specifics, for instance, of 155K10, Roman numeral 2, 3, 4, and 7. These are some of the examples of matters that we think are more suited to be disclosed to regulators and maybe to clients who request it on an RFQ basis, but to disclose them to the whole broad public may be problematic for us. And again, it may hinder what we understand to be the purpose of the proposed regulation, which is to protect clients. So I'm thinking specifically of 155K10 Roman numeral 2, the dollar value of the FCM prop margin. We struggle to see the benefit of disclosing it to the broad public. Or the number of futures customers, we can disclose that on an RFQ, of course, full transparency to regulators, but to the broad public, that gets into the area of, our commercial interest and our competition with other FCMs. Also, the non-hedged principal OTC transactions under 155K10.4 is also something we would disclose on an as-needed basis. And finally, the balances written off. We think that can be a little bit misleading. In other words, did we write them off because there was a problem with the client or because we don't know how to run our business? So, that is information that needs to be disclosed with some commentary around it and to the appropriate recipients. So that's, broadly speaking, where we are.
Thank you. Ron.
Yeah, just want to add what Bill and Alexandra, there's a tremendous need for that balance of what is public and what is reported to the regulators on a confidential basis. And we all can disagree or agree on some of the basic reports. I was on the NFA committee that led to Section 16 and all the reports that we did, and Tom can correct me if I'm wrong, but I think it was only comprised of the public directors at the time. I'm not sure whether any industry directors were on it. And we went through a survey of all these reports that were going to be recommended. And it was, I'm not sure if it was unanimous, but it was pretty much unanimous among the public directors of NFA which of those reports should be made public. And we recommend also that those reports that should be made public to the general public be done on the NFA basic website under each FCM, so there's one source, as opposed to having it on the FCM website and everything. We highly recommend whatever reporting that has to be done to the public go through the NFA website. It's called Basic, and you can write in or type in any firm and get all the information about that. So I think it's a delicate balance. It's there are different views, but I think the more and more you decide which of those things should be reports may be public and non-public is a very critical. And I look forward to hearing more discussion among the group here. But we did that on a report by report basis on the special committee, and we came up with what we thought were properly reports that should be made public and those that should be made only to the regulators. So they're going to NFA or to the CME right now, and whether you guys get access to it or not. I think sometimes it should be for your eyes only. And then if you want to require something more down the road, that's something that the regulators can then decide.
Thank you. Grace?
I agree with Ron's comments. I have a concern that if certain information is made public too early, it could create a run on the firm. Liquidity is the lifeline of broker-dealers and FCMs, and if lenders lose confidence, and there's a run on the firm, then the customers may end up in a SIPC liquidation. We have certainly had instances where we were aware of issues and we worked with firms to transfer customer accounts in an orderly fashion to another broker-dealer and another FCM.
Can I just, for the sake of conversation, I want to push back a little bit on both comments. So I remember that, for instance, whether and Tom could correct me if I got this wrong, but the NFA's notice to the public that an institution was engaged in prop trading would be a check the box. And I also remember dealing with a crisis entity that we were involved in where the public securities markets were getting information because an affiliated parent had public securities, but the FCM customers, at least not directly, weren't getting any information directly, but there was public information out there, but really for the securities markets. And I just am not sure that I find, and I understand the run on the bank concern, but in terms of finding the balance, I'm not sure that, check the box on one item is enough, and I'm also concerned how far one would push the, the information back into the entity. People want to invest $1 million into an operating company, they get disclosure. If they want to, put it into a commodity pool, they get disclosure unless there's some sort of exemption, but then they entrust it to an FCM, and there's a markedly different amount of information that's available to the customer. And I'm not sure that, so I take the points that there is a balance that needs to be, there's competitive, there's confidential issues and so on and so forth that need to be taken into account, but balanced against the interest of customers who are entrusting funds to these institutions.
Yeah.
Go ahead. Yep.
FINRA has rules that restrict broker-dealers in the event they're approaching financial difficulty, and that financial difficulty can be as a result of certain capital levels, or it could be because of operational problems or liquidity problems. We have some latitude with respect to restrictions, and those restrictions would be, maybe not taking on additional customer accounts, not opening new offices, not increasing the size of the balance sheet. Those restrictions vary depending upon facts and circumstances, but that may be something that you want to consider on the FCM side.
That's a good point.
If I could just push back a little bit too on this concept of run on the bank. I think first of all, when you think about a run on a bank, we've got banks that take in short-term deposits and make long-term loans. So obviously, if something happens with the bank, they don't have the money to pay the depositors out immediately. FCMs, on the other hand, are getting customer assets as margin to cover their trading. Under the rules that have been passed and that are proposed even in this proposal, the margin levels, each customer is meant to pay their own freight. Each customer is meant to put the margin in and ultimately get the margin back. And the concern that I would have, and certainly for Vanguard shareholders, is that there's information that is going to the CFTC or the SRO that, if it was in the market, would allow each client to make a decision. Is it appropriate to continue to use that FCM as your FCM, or do you need to find a new one? I also think that while in the past we've lived in a world where there has not been full and complete disclosure to the public, and it has been more on a ask, and if you're a great client, you may get some information basis. If in the future these reports are common knowledge and are out there on a regular basis, they will be taken into consideration by individual clients so that they will not necessarily act on a knee-jerk basis and move their money, but they'll be thinking about their business relationship, whether or not the failure to satisfy or comply with an obligation is an administrative error that can obviously be fixed, can easily be fixed, and look at their alternatives in terms of whether or not there is an FCM that can take their trades. So I push back a little bit on this run on the bank. If there is a problem with our FCM, I would rather have the information, be able to take the margin, which the FCM is required to maintain, take that and transfer it to a new FCM, and port our trades.
I think it helps to be specific. So in other words, I agree with every statement that has been made. So the question is, how do you apply? So for instance, what Bill was saying, which I agree with, you need to know where you stand as a customer. So let's go down to the details. So if that means daily statement of seg requirements, then I understand that. If that means that you want to know my proprietary positions, then maybe I see that a little bit less. So, I think it'll go down to the specifics of each proposed regulation and then, thinking about whether that specific proposed regulation is suitable for disclosure to the full public, to customers, or just to regulators.
Can I just further comment on what Alexandro just said? As Kevin was going down all these post-event reporting, many of them deal with what I'm going to put under the big umbrella early warning type issues. Material, to me, those should be for the eyes of the regulators only, because how you interpret it, a lot of times you have an early warning and you can fix the problem within the 24 or 48-hour window. And so I think it's very important that when you deal with some of these post-event reporting, those should only go to the regulators, not be made public. If the regulators thinks that there should be some enforcement action brought, it will be made public in a very short period of time. But I think a lot of those types of reports are for the eyes of the regulators only, and it gives you guys a better opportunity to do your right job.
And I think I agree as well. I think it's fair to make a distinction, which is why in my opening remarks I focused on, I think, 5 different areas that we really felt were appropriate for public reporting, immediate public reporting. And I think some of the points that Alessandro was saying probably are more of a competitive business nature, so maybe aren't completely appropriate. But I think the key things are the segregation computations, the residual interests, the financial statements, the reportable events, and also one that I didn't mention, I overlooked, was the twice monthly reports on investment data. So, and that's a one that we actually do talk to our FCMs about quite a bit, and they actually use it as a selling point, so they can invest the assets in the broad range of options under Rule 1.25. Some of them report at the top end, the most liquid end. Some of them invest at the top end, some of them invest otherwise. We tend to favor FCMs that have a more conservative approach. So we'd like to see that report as well.
James.
I think those are all a good start. I think we need to go a little bit further, though, than your proposal on Rule 1.1. 0 to expand reporting on balance sheet leverage. Monthly is a good start, but if you look at what's available in other aspects of the market, such as the CTA, CPO side, which is where I represent, any sophisticated investor could look at monthly numbers and get somewhat of an idea, but you really need to look at what's going on an intra-month basis. We've seen multiple issues on the securities world having to do with window dressing and firms simply getting their leverage requirement in there the last day of the quarter. And I think by mandating that FCMs only disclose their balance sheet leverage on a monthly basis, it doesn't go far enough. I'd like to see average leverage over the course of the month and also the peak leverage to try to curtail the window dressing practice.
Reactions to that?
Well, I certainly agree.
If I can just follow up on Ron and Alessandro, one purely hypothetical situation, we talk about being careful, disclosure, whether it's under seg issues, because yes, you can have a firm that something happens and they go under seg, but cure it within 24 hours. So there is caution to be had on disclosing something like that to the public to misunderstand what happened, don't have all the details and the facts that the regulator would have in responding to that. But would it be beneficial or harmful, for that matter, if, let's say, within a 24-month period or 12-month period, saying, well, and again, purely hypothetical, that a firm might have gone under seg 4, 5, or 6 times during that time frame, and all may be very legitimate operational errors that just happen. But, is there merit to looking at that type of disclosure to help the public be aware that, they had a one-off, but now it's 4 one-offs within a one-year period?
Oops, sorry. My only comment is you just brought an enforcement action against an FCM that did not, or was under SEG for more, I think it was over a weekend and another day or so. So the CFTC has acted very promptly in bringing an enforcement action against that firm. The question is, under what circumstances should those types of notices be made public? And an enforcement action is made public. And if that's not a better way of saying this firm wasn't consistent, you can take that approach. I don't know what the right number is, Kevin. Or should there be a number? But I think it's more important for the CFTC to know that an FCM is under SEG, so you can take the appropriate actions.
Yeah, you're right on the enforcement action, though unfortunately it takes a little bit of time before those enforcement actions become public.
I think you want to create a culture where very, very, very quickly after or at the time when a problem is discovered, one of the first calls is to the regulator to say, look, there's something, we're looking into it. And now I'm saying that if you have full knowledge that that's going to go straight through to everyone, then that will make you want to understand what's going on before you call regulators and maybe take a little bit more time. It's just a fact of life, because if it's kind of a suicide note to say, look, there may be a problem, and then the market essentially completely moves away from you, it becomes a self-fulfilling prophecy. So I think, again, it's about the specific fact-specific issues in each case. But I think you also want to create a culture of transparency, but also of being able to raise issues while you're investigating them internally, so that I think that will increase systemic stability.
James.
I agree completely that transparency and enforcement is very important. I think that adding new rules is incredibly important, but even more so is that the actors in the marketplace need to know what the penalties are, so that one, they can make sure they're compliant, but two, to create a deterrent from breaking those rules. So for example, in your proposed change to Rule 1.20, where we're labeling the accounts as customer segregated account, I think that's a great change, but we need to know what's going to happen if someone breaks that rule. So say someone, let's call him John Corzine, decides to transfer money out of the customer segregated account and use it to meet a margin call at a bank, let's call him JP Morgan, what's going to happen to Corzine and JP Morgan? So like, for example, in MF Global, JP Morgan is still holding customer segregated funds that were transferred to meet a margin call over a year ago. So where's the, what's the enforcement action there? Like, that needs to be clear so that situations like that don't happen again.
Okay, well, and obviously we're not going to comment on MF Global or anything where we have ongoing matters. But the idea that we have, it's so fact-driven, and there's so many other, I'm not sure there's a way to do that, but I heard what you said. Other thoughts? Michael?
Yes, first of all, I want to congratulate you on the proposal. We can debate refinements to it, but I think the overall direction is very, very good, and I think when implemented will do a lot to reestablish the reputations of these markets, which have been so badly damaged. I agree that careful thinking has to go into drawing the line between not proprietary investments, but proprietary information when you're disclosing proprietary information that really I don't think is going to help the customer all that much. I think there's a lot here that we can agree on that will help the customer a lot. In that vein, whatever the resolution of the problem is, I would caution in establishing what you want disclosed, not using the likelihood of enforcement as being a deterrent, because let's face it, not everything gets enforced. And secondly, I think once we decide what's important for the customer to know, a lot of the value here, we don't want unnecessary runs on financial institutions, but a lot of the value here is to let the customer know what's going on, not relying on the CFTC enforcement completely or SRO enforcement, but relying on the customer having knowledge to make intelligent decisions. The other thing, I agree with a lot of Ron has said, knowing particularly, the problem with MF Global and Peregrine is you got a lot of unsophisticated customers. You don't have the big buy-side people, as I understand it, getting swept up and damaged as much as you do the rancher, the farmer, et cetera, et cetera. So I would not limit posting the information on one website like the NFA website. I think it should go. Now, again, I'm not saying proprietary investment information or anything else. I think we have to be very careful about what's useful to the customer and what is unnecessary disclosure in terms of proprietary investing decisions. But once that decision is made, I really think it should be put up wherever it can be put up. Using the NFA websites, I mean, for the skilled and people who are in the industry all the time, that sounds pretty easy. But to a customer accessing that website as opposed, the most natural thing will be to go to the FCM's website. So I think when we decide what needs to be publicly disclosed, it should be disclosed reasonably, not unnecessarily, but reasonably on the broadest basis possible. The other thing that I think is, final thing I would say I think is terribly important is whenever we decide what is going to be done, I think there need to be checklists or, Kevin, just the way you in some way went through this, saying here's a list of things, pre-event, post-event, everything else, because I applaud the carefulness and detail of the notice of proposed rulemaking. But when you combine that with the regulations, interpretations, and everything else, it's hard for somebody to go to one place at one time and say, this is what I know I can get. And that really should be backed up with webinars for investors and everything else. Because from my experience, the small investor has this global, at least prior to MF Global, had this global assurance that the safest place they could put their money was in a segregated account in FCM, even if they weren't doing futures trading, that it was better than having it in a savings account. And I think there needs to be much more sophistication given to customers, especially small customers, about what this is all about, what the risks are, and what the tools are that you have to make sure that your money is in fact segregated.
Thank you. I think that, one small point, I think to put things in perspective a little bit is that all of it fits together. I mean, the idea that, you have rules that say don't speed and then you rely on enforcement or, the police guy catching you and giving you a ticket versus, sufficient risk management requirements and control-oriented examinations and disclosure to customers that informs them, but also incentivizes good controls. Finding that balance, though, is important to see it all, how it fits together. But I think that too much reliance on just deterrence puts us back to where we were. Nobody can catch it all, and if you just are going to go, rely on the stated rule like you will seg funds, and if you don't, we'll get you afterwards and give you a punt. It doesn't do enough risk mitigation.
Can I just mention just a few things? And it's Tom Sexton from the NFA. And as Ron indicated, our special committee of public directors went through this process already with regard to some of this information, some of the considerations I think the commission is now considering as far as reporting and disclosure. I think and Ron's exactly right. There is this balancing that needed to occur, and the balancing is not only what should be made public and not public and reported only to regulators, but the factors that I think that the committee took into account were there's a balancing of of firm type, FCM type. So I think we always like to picture the largest FCMs being and what they should be disclosing, but you also have to realize that there are smaller FCMs, and how this disclosure of some financial data may appear in comparison, I guess, to the larger FCMs, I think can be somewhat misleading if you look at numbers alone. And it's very hard to qualitatively describe differences in those numbers when people are only going to be looking at numbers, I think. So you have the size of the FCM. The other thing that I think the committee balanced is, and this goes to more of the customer type and who's going to be reviewing this information. And obviously we run, the whole gamut between retail customers and institutional customers, and certainly some of this information may be very worthwhile to institutional customers, but the retail customer is going to get lost in the complexities of this information. And that was something that our committee balanced in coming up with what is at least what basic information should be provided to everybody, retail, institutional, that would be easily understood. So when I look at the proposal, I think, and hearing the comments today, I really think there are three buckets that the Commission should consider. And I'm not here to tell you what falls within each bucket. I think you're going to have to listen to the comments on that. But one is, in general, what should be made available with regard to all FCMs. The second is what should be made available mandatorily upon request by customers, I think. And the third is, and this goes to Grace's concern and others, is what should only be reported to regulators, because the regulators have to do their jobs and have to assess the firm and make sure that if there is a lifeline to give to that firm, that the firm has adequate time to do so before information hits the market that may be totally disruptive to everything if it can be solved short of that. So those, to me, are the three buckets. And I can tell you that when it comes to issues like proprietary trading, and that was something that was brought up, and we had a long discussion on proprietary trading and what to make available or what to disclose. And ultimately, we decided that, and this goes to the harmonization issue, that there has to be harmonized definitions as to what proprietary trading is, what leverage is, because we collect leverage now on a monthly basis from our FCMs. I can tell you that depending on that leverage calculation, as to what, for example, whether or not you include seg funds in the calculation or not, you come up with vastly different results for that leverage calculation that if you were to show that publicly, I think could potentially be very misleading as to what the condition of that FCM is. So these are all tools, I think, that we can use as regulators, that perhaps there are some way to achieve definitional conformity, I think, among different regulators as to what should be made public. But that's a lesson and a time that we're going to have to take to do that. And you can't just say, well, this is what the definition is going to be, because, as I said, it could be vastly different in the securities world or someplace else.
Yeah, Mark.
I'd like to just pick up on those thoughts. Speaking, for Goldman Sachs and for SIFMA, we certainly too would applaud the direction in which your proposal is going and the things that you're trying to achieve. We would note, and I guess I'll speak now for the SIFMA group, but we would note that firms, and again I'm picking up on Tom Sexton's thought, are in very different places with respect to a lot of these requirements. For example, if an FCM is included within an organization that is a public corporation, is included within an organization that ultimately is a financial holding company or a bank holding company, it's already meeting many of the requirements and has been for some time that the CFTC is proposing. And additionally, an awful lot of public disclosure surrounds our meeting those requirements. And I think our concern and hope is in terms of harmonizing your requirements with pretty substantial and detailed requirements to which we're already subject. But again, we applaud the direction, but I think some folks, some types of firms are already doing an awful lot in the context of the goals you're trying to achieve.
Thanks. Yes.
I think the NFA has made a great start with the financial reporting that's available on BASIC. And the last thing I think anybody wants to do, especially to retail investors, is to drown them in information, which would have the effect of burying relevant disclosures under a sea of meaningless data. But a couple things I'd like to see, and this is something maybe Tom and I could talk about separately, but is to see things, a little bit of analysis on there, like see the ratio of excess SEG to SEG funds listed on the website. Look at things like your proposed revision to 1.10 and balance sheet leverage, and put that number on the website, and you know, hopefully throw in that average over the month and peak leverage as well. And I think we'd also like to see that data being able to be manipulated a little bit easier, like maybe downloadable Excels or a mechanism to compare FCMs right next to each other a little bit easier, because I haven't spent all that much time with the system, so correct me if I'm wrong, but I think to access each firm, you've got to type in their name and look at them individually. So, I mean, it might be a little bit better if you could look at them all side by side and maybe, say, group the bank FCMs together and the BD FCMs together and the firms that handle more hedge business or smaller spec business. A little more peer group analysis.
Thank you.
Hi, this is Rich Horgan. Just to address the balance issue, maybe to extend Tom's approach would be for the regulators to gather a lot of this information and allow some time to analyze the data and then bring forward more public disclosures. I think some of the concerns that are raised here, for example, the proprietary trading or some of the SEG fund information, if you allow the regulators to analyze the data collected and then over a time period continue to disclose that information, whether it be on the FCM's website or through the regulators, the NFA, that might be a more appropriate approach versus just disclosing everything immediately and potentially confusing whether that's the large investor or the smaller investor.
Thanks, Richard.
Gary, just to build on what has already been said, I think the key factor here too is making sure there is harmonization in the description of the terms that are being used, like liquidity and leverage and so on. I think there's some different definitions out there that could be applied across, say, a broker-dealer versus an FCM. And I think those standards need to be harmonized in order to give a much clearer and level playing field for the clients.
Okay, thank you. Can we go back do we have another? I wanted to ask about the issue that was raised about, Tom raised about the smaller firms and then also the retail customers. I mean, the closest we could come to deal with that situation was we added to 1.55B standard, additional standard disclosures that where we thought that they had not understood things, where we got input from people that there were things they were surprised by, and so we tried to beef that up. But we didn't think that should mean that we get less information that more sophisticated investors or customers were asking for in their analysis, so we just kind of added in 1.55B, and then we added the additional disclosures that the more sophisticated investors should have. I hear the concern that smaller firms may not be able to, may be concerned about what information is being shown and that might put them at a competitive disadvantage. But how can we balance that when how should we balance that? It's a reasonable goal, but on the other hand, on the other side of the teeter-totter is still customer protection of their funds. So what are some of the things we should think about and if you don't have some of those shops, then your retail and customers also don't have a place to go. So we're aware of that as well. So thoughts about the retail customer and the smaller shops, I mean, more thoughts about how to accommodate those concerns and yet protect customer funds? James?
I think just market forces in and of themselves prevent the smaller customers from doing business with a lot of the bank FCMs. A lot of those FCMs have $1 million minimums to open a clearing account, and that's just not feasible for a retail customer. So I think you have to look at the existing market structure for those retail FCMs and see what's working, what's not. I know one selling point that some of the leaders in the more retail-oriented FCMs are using is that they don't engage in prop trading, or if they do engage in prop trading, it's done in an entity separate from the FCM, so that you don't have the risk of a blow up at the in the FCM seg account potentially affecting customers. So I think really the main focus should be making sure that those FCMs are compliant, they're setting adequate reserves, they're not over leveraging, but then allowing them to disclose their prop trading policies and what kind of risk, if any, they're taking that could infect customer funds.
Todd?
Yeah, following up on James' comment a little bit, our members are primarily hedgers. They're grain companies that purchase from producers and then hedge their risk, all the way from very large to very small. But, in terms of the kind of information that they would like to see, a couple of thoughts. Number one, a lot of firms really are, they see as very important doing a greater level of due diligence today, particularly post-MF Global. We need that information up front. We also need, without getting into a judgment of what's appropriate to reveal to regulators and what's appropriate to reveal to the public, they do need information on FCM performance, and maybe early warning is the wrong way to put it, but the ability to switch to another FCM. They need some public information to make those kinds of judgments. I would say, too, that we're very sensitive to the concern of unequal impacts on the very large FCMs versus some of the smaller to mid-size FCMs. Those are typically, the smaller mid-size firms are typically the FCMs that our members do business with, often due to historical relationships, personal relationships, a higher level of hands-on personal service. And we would certainly urge the Commission to be cognizant of any sort of unequal results as a result of the information that is available to the public. Having said that, I think we would err more toward the side of more public disclosure instead of less.
Okay. That's a hard balance.
I think building on that, and I certainly agree with those comments, particularly in the swaps market, you have to keep in mind that there's going to be a certain range and a large range of standardized swaps that are mandated to be cleared. And there simply will not be another way to trade those swaps. So I think it becomes even more imperative that information about the FCMs is made public, and the folks that are forced to clear in that manner have that information to be able to make that decision. I would also question that following MF Global and Peregrine, I think that small or large, everyone is focused on due diligence and is hungry for that information to be able to make those decisions, because they know, I mean, certainly the point that was made on the other side of the group here, before MF Global and Peregrine, folks may have thought that putting margin up to their FCM was the best protection they could ever have. Certainly now they know that's not the case. I think it will be much, much better tomorrow, given all that the CFTC has done. But notwithstanding all the protections the CFTC has implemented, information and the ability to port is the final backstop for clients to protect themselves.
I just want to share everyone else's thoughts. I think the CFTC is taking the right approach and direction. I mean, if you think about it, if you pass or adopt many of the proposed rules, all investors, whether you're retail or institutional, is going to get a lot more information than they've ever had before. Is it the proper amount? Should there be more? I mean, time will tell, but none of this information in the last 40 years has ever been disclosed And within a few months after you adopt these rules, there's going to be a lot more disclosure required. You're changing the 1.55 standard risk disclosure statement and adding more disclosure regarding those lines. I mean, I think from a balancing and everything, I think it's the right direction what you guys are doing, or the Commission is doing, and what the NFA has done. The other part of it is, I mean, we all have to protect the retail customer, and every rule and regulation by the CFTC or the SEC or any regulators protect the public customer. But to be honest, in the futures and now the swap industry, the percentage of players who are, quote, retail is getting smaller and smaller. Doesn't mean doesn't need the proper customer protections, but I think with these extra disclosures, they're more informed. NFA or CFTC, I think one of the responsibilities of both is to provide more education, consumer education and advice. And the more we do, I think we're just going to be a healthier industry going forward.
Thank you.
This may be a little bit beyond the scope of this panel, but one of the things that we've really seen from the retail customer is a desire to have some kind of insurance regime, and you know, there's different ways to go about implementing such a thing. Like Commissioner Chilton has put forward his plan. We've seen a lot of pushback from that from some of the exchanges and bigger players who don't want to pay for the insurance. And so in response to that, our organization has worked with some of the organizations like National Grain and Feed and some of the exchanges, some of the more retail-oriented FCMs, and developed a plan for private opt-in insurance. We've shared that with the Senate Ag Committee and have talked to Commissioner Chilton about it as well, and plan on showing that more to NFA and the CFTC should you be interested.
Okay, thank you. Michael? Oh, sorry. Go ahead.
Okay, from the agricultural production side of things, we look at things just a little bit different. We aren't looking at investments, we're looking at risk management tools. And that's an entirely different game than what we do anywhere else. We're looking at protecting the market movements in our funding. What has happened with MF Global is we've lost that trust factor involved in working with futures, and that's the futures are about the only thing we have to do this risk protection type of system. So we got to look at something, and the transparency that we're talking about of the FCMs is a good thing. I think it's moving in the right direction. But we have to continue to make sure that it works for the smaller FCMs as well, who works mostly with us in production agriculture. So we have to watch it carefully. We don't overregulate and increase costs so that it's at a burden and going above and beyond where we're at on that. As far as additional regulations, as I said, we got to be careful of the cost of that and the possibility of making sure that the oversight by the DSROs is there so that we know what's going on and things are informed there. One suggestion, and I'm going to throw it out as it's been brought to me by producers, is the possibility of opting out of segregated fund usage by the FCMs. We know there's going to be an additional cost with that, but you're looking at small people that can't afford any kind of losses, that have basically went out and financed their margins. So they're very, very concerned about the loss of the margins as happened in the MF Global situation. So I'll throw that out as a possibility just to think about that option.
Well, thank you. I mean, I think the big picture is that either whether you have insurance or you have an alternative to holding seg, the point is the operational risk that we're trying to address without those. And without those, this overall package and the need for disclosure and risk management, but if you change the equation because you have an alternative to holding seg or because you have insurance, then it does change the, it's like a spreadsheet, you know, and it does change the analysis. But we're needing to move forward in a sense with what we have, and we know that those things, in this panel, we're not addressing that, but well aware of how James, and your points about insurance or an alternative to seg or something like that would impact that analysis. So thank you. Michael.
Yeah, I mean, I would just say as to opting out of seg, I think the CFTC, going all the way back to 1936, has tried to make it clear that you should not opt out of seg. it's an open invitation. I think probably what you're thinking is if the FCM doesn't have to put it in a segregated account, it can invest it much more profitably, and therefore the cost of the FCM isn't as high. But I will tell you, if you're telling an FCM that they can put their hands on that money, it's an open invitation to theft. I think it would be very, very counterproductive to have.
I think when I hear the term, having watched the discussions, I think that the thing about opting out of SEG is a colloquial term. And I think it is about how it's held and who can access it. And sometimes some of the systems are talking about the need to change the code to make it work. So it's not necessarily.
All right. I know that this has been discussed and fought, but I just think if we're talking about the FCM having free access to the funds, commingling the funds, or anything of that sort, it's an open invitation to more problems than we already have.
Understood.
And I am sympathetic to the concern about the small FCMs, but I don't know where you rank Peregrine in all this, but to my mind, and maybe I'm elitist, Peregrine was a small FCM, and you can say, well, that was a one-off, but to my mind, if you're going to be an FCM, whatever your size, you do have responsibilities to protect customer funds. Now, I think we should be conscious of not overburdening the FCMs, but I think these obligations are very, very important. Going back to the shrinking retail user of futures markets, I think MF Global is a reason that the retail is shrinking. I think we should try and be increasing retail. If the commercials aren't hedging, the ultimate consumer is at risk to volatile pricing in the commodity. The benefit of hedging is there's a assured risk management of price, and that benefits the consumer. And I think one of the things that has driven the retail sector out is the shock of MF Global and Peregrine. I think there are other factors, but I don't think we should give up on retail. And that just brings me back to a point I just want to make again. I mean, I think the biggest protection to the loss of seg funds is the investor being fully informed about the status of the FCM. I agree we don't want bank runs, but we do need enough information. The CFTC is, I don't know how many guys you have now, but 700 guys looking over a $300 trillion notional value market. It's comforting to say all this information go to the CFTC, but I think the only way the investor can be protected is the market forces intelligently deciding which FCM deserves the business. So I again would like to see the CFTC get as much information as possible in the SROs, but I really think the investor is the ultimate protector of the system. And by the way, the more information the investor gets, the harder it is for the investor to complain after the fact. So it's cuts both ways. It cuts both ways. All this information may be available, but nobody may be looking at it. Something goes wrong, and then they've had notice of the problems, which puts them in a bad spot trying to recover their funds. The final thing I would say is Richard's point about what I understand Richard to be saying about the CFTC looking over data before it's made public is that would be the data that you don't want to go to the public, not when we decide what information the investor needs and what information should be rightfully proprietary. The CFTC shouldn't be holding on to the public's information. That should be gotten out as soon as possible. It may be that one way around worrying about proprietary data that Alessandro has talked about and others is that information goes only to the CFTC. I think that's right, and not to the public, or the SROs maybe too. I don't know where you draw the line.
Thank you.
And I just want to make sure that everybody's clear from our standpoint. Today, any type of investor, institution or retail, can get information from NFA's website on seg funds, seg fund investments, capital, whether or not the capital is held in an affiliate or not, and that's available to anybody. When I look at, though, some of the requirements of 1.55K10, which I think Alessandro referenced earlier, I'm not sure when you have a retail investor whether or not that's going to be clear and concise to that retail investor as to what some of those factors are. And that's the information that I would encourage the Commission to think about making available, that the FCMs have an obligation to make available upon request. Certain of that information, I think. And certain of that information, I think, could possibly just be disclosed to regulators in their oversight and risk profiling of FCM. So I am not arguing that information should not be available to retail participants. By all means, we have done that for years. We favor doing it on NFA's website, where not only can you review the financial information for FCMs, but the disciplinary information also is all right there in front of them. We have adopted a rule in certain circumstances requiring certain of our members, I think in the Forex area, for example, to upon opening an account that customers should be made aware of NFA's website and the basic system, and then they have to provide that notice once a year to all customers. We could certainly think about doing that also, depending on the type of information that's available on our website. If that's the direction that the Commission wanted to take and direct customers to our website, we could do that for all members. I don't have an issue with that. So that's where we are as far as disclosure today, and where our special committee has moved us from simply months ago, and with regard to many of these items that the Commission is seeking to disclose today.
Great, thanks, Tom. Grace?
One concern that I'd like to raise, if the required public disclosures are proprietary and intrusive, we may return to the day when the broker-dealer and the FCM were two separate legal entities. And the concern there is that the information you'll get on the FCM will be public, but yet if another part of the organization is in trouble, they're all going down together. History has shown us that.
Michael?
As to that point, one of the things I thought was very good about the proposed rules, and I think it's embedded in the statute, I don't remember what provision in terms of the responsibility of auditors, is that you're not just supposed to look at the FCM, but you're supposed to look at corporate-wide institutional affiliates on the theory that if the affiliate goes down, the FCM could be doing everything correctly, but if the affiliate goes down, the money can be gone like that. And I do think your rules have a lot embedded in them about the responsibility of looking at affiliates, not just looking at the FCM itself. So I applaud that. I think it's very important. I know lots of situations where an FCM is just doing fine, but an affiliate is tanking and brings the FCM down.
I wanted to agree with the points that were made earlier by Grace and by Michael, especially considering that in the broader spectrum of Title VII, we may see some consolidated market participants that are FCMs, broker-dealers, swap dealers, all in one. And so I think that it would make sense, again, to get the calibration right. And it is all about the specifics, as I was mentioning before, about essentially K10. So getting the calibration right encourages, well, takes away a market distortion that would encourage a further split into different subsections to, if the rules don't make a lot of sense. And so I think having rational rules, which we're very close to with this, that provide the adequate level of disclosure for the adequate recipient is something that should be applauded.
Thank you. Go ahead.
Yeah, I'd like to ask a question about costs. Implicit in our conversation thus far has been the idea that if certain information is disclosed and it's misunderstood by market participants, that could create certain costs. And I'd like to better understand what those costs might be, in part because it seems to me that that's something that's a potential risk with any information that is disclosed. And so are there unique costs here that we need to be cognizant of as we're trying to balance these considerations?
I think that, regulators are often in possession of information that allows us to work with a firm and to move customer accounts to a safer broker-dealer. So we have various alert and early warning criteria. Some of those criteria are based upon steady deterioration in capital levels as a result of losses or other risk-taking. And we work with the member firm that's a carrying and clearing firm to either turn them into an introducing firm where their customer assets are held by a stable clearing firm, or the customer accounts are transferred out to various firms over a period of time. Our goal is for the customer assets to be fully protected at all times. What I'm concerned about with information being out there publicly that may be there, we may not have adequate time to move the customer assets to a safe home. And again, it's a balance of getting the timing right and having information available to investors.
I mean, I guess the cost in terms of if you get it wrong, so for instance, if you, I don't want to use a hyperbole, but if information gets out about liquidity, potential problems with liquidity in a market dislocation, of course, lots of rumors run around. If you don't manage that information process properly, the rumor becomes reality even though there's no substance to it. And so the cost would be the death of a business and harm to customers. So I think it's a pretty high cost if you get it wrong. But the idea would be that if there's a problem with liquidity, you talk about it with regulators. If it's a real problem, you get it resolved, meaning you transfer positions to a healthy FCM or to a number of healthy FCMs that can take the volume, and that allows you to provide an orderly liquidation of the business if it's necessary, with keeping the public informed, but at the appropriate time. So that would be an example, in my view, of what the cost could be if the process is not run in a way that is efficient.
I'm very sensitive to the cost-benefit analyses that need to be done, and I think I must be candid with you. I skimmed the cost-benefit analysis, but it looked to me to be extraordinarily thorough. But the only thing I would say is the MF Global and Peregrine, you could argue, was $1.8 billion. Maybe that's all being adjusted now, but let's say at its worst, $1.8 billion loss of customer funds. But the loss of confidence in the futures market is a much, much higher figure. This goes back to those who should be hedging are not hedging. Business, I haven't looked at the recent statistics, but I know for a while futures business was down. I know at prior roundtables, the buy side has threatened if these things happen in the swaps, they're going to get out of the swaps market. So all I would say is I'd encourage that a global cost analysis be done, because MF Global and Peregrine were a real slam to the head of the futures market. I think unnecessarily so, and it's an ultimate harm to the consumer. And I just hope we do keep the global costs of customer funds being lost in mind.
I just wanted to mention that there are other areas of the rule where we think that we have more constructive comments that we'll be filing through a comment letter through the trade associations or ourselves. So I just wanted to mention that in the context of the cost analysis. And I just think that it is tempting to say, we've had these defaults that have caused these losses. But I think also there has to be a measure. So in other words, you have to allow FCMs to conduct the business and to make also a little bit of profit, which encourages healthy risk management. In other words, we all have our own thoughts on what the motivations for humans are to perform the functions that they perform, but you have to allow for a little bit of an incentive to run the business in a safe and sound manner. So my point is that I would encourage to continue in conducting an appropriate cost-benefit analysis, and that the support that we've expressed for this particular part of the rule, in other parts of the rule, we have more comments.
Okay, thank you.
I think as well, you think about costs, do focus on the benefits, and the true benefits are encouraging better behavior across the market. I think as well, the FCMs, some of whom are in this room, are FCMs, we have tremendous confidence in, and I think that the story that they can tell through public disclosure is a very strong one and a good one to hold up to their peers. So I think the benefit there is, take the light of day on the data and let the customers see it. It will encourage FCMs that perhaps have weaker practices either to tighten their practices or get out of the business. And the better FCMs will stand proud of the results that they can show, and their clients will flock to them. So I think there's benefits, and the main benefit is much better behavior and the market moving where it should move ultimately to the best FCMs.
Great, thank you. Anything else before we close?
Just on the cost item, I think it is something that was done very well within the proposed rules. I believe the primary cost is going to be additional staffing requirements that are going to be borne by the regulators and the FCMs, and that cost has to be factored into the services provided. So if you look at the analysis on implementing these requirements, it is going to require additional staffing, and that staffing has to be considered when managing the business.
Thank you. Bill.
The one point I think I want to make here too is that if you look at and we talk about cost benefit, but I think we have to look at the proposed regulation holistically, because when you add up all the different factors involved, the greater transparency, the daily flow of information that did not exist, the better tools that are coming out of the NFA and the CME on a daily oversight, periodic inspections. Again, put all those together, I think that builds a lot of confidence in the industry and in the clients. And I think the balancing part of that is that I really believe that you should err on the side of not disclosing information, let it evolve a little bit, because all these other oversights, all these other reporting requirements, all the early warning you're putting in there is providing, I think, a lot of confidence to our clients. And, we would hate to have all that taken away because we were a little aggressive in what we disclosed and it got misunderstood, and you revert back to that level of lack of confidence or questioning the rules and regulations and the oversight. So there is a lot that is being comprehended within these proposals. There's a lot of work that the FCMs need to do in order to be compliant. And I think the reality is that other than two bad apples, the industry has a very good history of being compliant and providing, information to our clients and providing, good controls and so on. Can we do things better? Of course we could, all right? But I think if you look at the size and the breadth of most of the FCMs, they're highly regulated. Most of them are duly registered as broker-dealers and FCMs, so they have a tremendous amount of oversight. A lot of the larger ones are under bank holding companies. So we do have the alphabet soup of every regulator in the world looking at us. So I think there's a lot of disclosures that go along with that. So I would just suggest to you that we need to take a much more holistic approach to these issues. And although we're having these panel discussions on very, focused and segmented items, I really do think that you have to start taking a much more holistic approach, because this is something that weighs very heavily, I think, on the FCMs and could actually work against you in the long run.
Thank you, Bill. Anything else? All right, well, thank you all very, very much. Really appreciate it. Thank you.
Thank you.
Okay, we'll be back at 2 o'clock.